Well, thank you everybody for joining us for another night, another seminar over here. This is going to be it for a few weeks at least. So this seminar was actually a subset of the larger seminar I did on the market update, but I thought that this actually deserved its own section over here. And this is actually showing you should you diversify from the Mag 7? Because you have people who are now saying, well, I'm just going to buy Apple or Microsoft or Tesla and Nvidia, and who needs anything else? And basically, when you look at the stock market right now from a valuation perspective, the stock market is fairly expensive based upon all different metrics you can look at. It's about one standard deviation in excess of what it's normally should be. But when you look at this from the perspective of what's going on um, in the AI investment boom. I mean, I'm not. This is to say that the U.S. is actually putting a lot of investments into AI. They're outpacing the next 10 countries combined, and that could be potentially future growth in that. And the valuation again for that is really it's still the stock market is fairly expensive when you look at it based upon dividend yield. You look at price to book, price to cash flow, all those metrics. The stock market is expensive, and when you look at it, uh, a lot of the stock market right now, it's driven by tech-driven spending. You have the Amazons and Alphabets and Metas and Microsoft spending billions of dollars on building up all these data centers. And that money is it's like an arms race, but they have to kind of stick in there then too. When they do that, there's a lot of money being spent, and kind of like a backdoor way of playing the AI, craze that's going on right now is the electricity is actually an interesting source that you'd want to look at, because a lot of these data centers, they're really not going to be useful unless they have energy and electricity behind the scenes driving the data center. And the electricity demand is expected to be exponentially high. And unfortunately, I think for us consumers, or at least me as a consumer, that means I'm going to be paying a lot more for my electricity because the data centers are going to be using up a lot more of that. That's why I'm starting to use a little chat GTP right now to get my share of this data center thing. And electric vehicles are also increasing. So that's increasing electricity consumption here. Now, with the AI, it's actually going to unleash faster productivity growth in the future. And this is kind of showing you, like, after these major events that they've had in the past with like steam and railways and steel and automobiles and electricity and aviation, all these things, there was great growth after that happened over there then too. And that's actually kind of interesting. We're expecting great growth in these type of things. But when you look at this, I think this is really what's interesting about it, is like a lot of growth that's expected in the future is really going to be from this businesses using AI to produce goods and services. So it's showing you like all these places where you normally wouldn't think of using AI, things in like real estate and entertainment and recreation and all these other areas, they're actually expected to use AI. It's a large extent is going to be in information and type things, but professional and technical, there'll be a lot in there then too. So pretty much there's a revolution going on. It means you want to be part of the revolution, and it's going to be used in healthcare and transportation and automobiles, agriculture. So all these places are using AI. So that's the good news, and there'll be a lot of efficiencies. But I think the point is that a lot of these efficiencies that are going on over here are going to be in these areas, not necessarily in the Mag 7. It's going to be spread out to the other. It's interesting, they call it now the 493, which is actually the other 493 stocks in there. Now, what I think is really a telling slide over here is that some of the 10 largest company weights in the S&P 500. So the top 10 companies in the S&P 500 are about 38%, which is really like at an all-time high for that. It's kind of interesting. You talk about what was the worst performing Magnificent 7 stock year to date, and it's been Tesla that really hasn't done quite as well. And there's been a large spread between the winners and losers. Nvidia's done really well, and Tesla not so much for that. And AI is sparking a sustained capital reallocation. They're going into chips, data centers, and power, and all these other areas over here then too. And there's a lot of again a lot of areas that really are going to be a lot of hidden areas that people aren't really aware of that are going to be using a lot of AI. And there's also things going on in robotics as well. Now, when you look at this, uh, it kind of shows you as of August 1st, the S&P 500 and, without the Mag 7, what it's done. And it's been pretty close. When you look at the earnings growth in the past, the Magnificent Seven was growing a lot more. Like this was the earnings growth was like 40% back in 2024, and the rest of the other 493 were growing at 4%. But now when you see going forward, the difference in earnings is not going to be quite as great going forward. So again, the valuations of the Mag 7 are, we'll see later, is much greater, and there's a big dispersion between what's going on between these different stocks in here then too. Now, I thought that this slide, I really found this really interesting. It shows you the weight of all these different countries that are in there. You have China and France and Canada, United Kingdom and Japan. It's a big countries. That's 15.8% of this world index. The Magnificent Seven is 21.5. So it's like six percent greater than these pretty large countries over here then too. So it kind of shows you there's really a huge valuation difference between those. Now, the other thing that's interesting about this is, we did the seminar last Wednesday. We were talking about tariffs and what was going on with that. And with tariffs, what's interesting is the Magnificent Seven are greater exposed to tariffs because they have a lot of international exposure to those things. So it's like, and we really haven't seen the full impact of tariffs. It's kind of like been slowly implemented since in the last couple of months, but that could be a greater drag for what's going on with Magnificent Seven over there then too. Now, I think that this is actually, if there's one slide here that is actually really, I think, the most telling. I think it's like everybody thinks that the NVIDIA is going to keep on growing at exponential growth, and we look at the valuations of that. And there's some other stocks that we were looking at that have huge price earnings ratio. Palantir is one we looked at the other day. It's got a crazy price earnings ratio, and I'm not saying that these are bad stocks. They're actually making money. They're doing well, but the growth expectations are really quite phenomenal in these stocks. But I think that this is kind of showing you, like, you think about, well, I want to own the top 10 stocks. And of all times you do that, it shows you if you would have done back in the year 2000, four of these stocks. I don't know if anybody in this phone call is old enough to remember this, but some of you are. Remember Intel and companies like Citigroup and Lucent? They've actually lost money since the year 2000, and GE was barely made anything, and IBM and ExxonMobil did much worse than the S&P 500. So it's kind of like showing you that it made more sense to be equally weighted even back then. The only stock that was back then that was still in the top 10 now, that was in the top 10 then, is Microsoft. So it's kind of interesting. This actually shows you on a world scale. It shows you, and I find it interesting because I like looking at history. You get to see the different stocks going back in time. IBM, AT&T, ExxonMobil, Schlumberger, these were Eastman Kodak. So all the great, all the companies that you think they can't fail. Well, a lot of these did. The Eastman Kodaks and the GE didn't do so hot. And then you had the Japanese craze where all these stocks were doing wonderfully. And then you had the year 2000. And it kind of shows you even back in 2010, like these stocks and how they're doing since then. So a lot can change over time. And it does make sense from a valuation perspective to not have all your eggs in the top 10 stocks. So, and it shows you the top 10 stocks have generally, even though they've come back nicely, they haven't done, quite as well as as a more equally weighted index here. And this is actually the key slide here. It shows you when the 10 largest companies in the S&P 500 have historically accounted for over 24% of the benchmark. Remember from earlier, we saw it was actually 38%. The equally weighted S&P 500 has outperformed its cap-weighted counterpart by an average of 5.5% over the next 5 years. So that's kind of like telling you, like if you look at history, which I believe you should, sometimes, look at history, it shows you that, you might want to have a little bit more diversification from those things because historically, like 24% was considered to be a great concentration. Now you're at 38%. And during those periods of time, it's done 5.5% over the next 5 years. And that's really the main point of this presentation. When you look at the valuations of these stocks, it shows you the top 10. They're currently 138% over the average, while the other stocks are actually just a little bit over the average then too. Uh, so it just basically shows you that it doesn't make sense to necessarily over concentrate in those particular stocks. And Again, the largest stocks in the S&P 500 trade at a significant premium to the rest of the benchmark. So there's better valuations outside of those things. And this kind of shows you when you look at an overall 60% equity, 40% traditional fixed income portfolio, if you did nothing in the last few years, it's kind of drawn down and you have a lot less in bonds and you're actually taking a lot more risk when it comes to where that is. So it makes sense to rebalance as at a minimum. So this is kind of a short and sweet presentation, just talking about why it makes sense to diversify from the Mag 7. So and this is again a subset of the other one. I thought I would try to do this in a more bite-sized fashion. So does anybody have any questions or comments?
Yeah, well, it looks like the Mag 7 is driving productivity elsewhere, right? Either on biotech or in the energy sector.
Right.
So you would expect those stocks to perform well over the next 10 years?
Well, that's the thing is that artificial intelligence and robotics are, I think, are trends that are here to stay, and there's going to be tremendous productivity gains in there. But sometimes, sometimes the gains you can get from those particular things are in other areas, like hidden areas. Like when you look at like what's going on in these other areas, like it's showing you here, there's a lot in
Yeah.
healthcare advances and data security and automotive, agriculture. Like you wouldn't think that those would be areas that would be getting advances, but they are. Education, even in my field, I mean, there's a lot of savings I can have by using things like ChatGPT and things like that that can do certain things. It's kind of like you need to be following the trends, and it should make people that much more productive. I also think it's when you look at it from the perspective of like what's going on with manufacturing right now. I think manufacturing actually is going to come back to the United States, but I think there'll be a lot fewer workers. I think there'll be a lot more robotics over there then too. So, so we will look at that, and I think that's something that that does make sense to look at other areas because there's a lot of boring type companies that you wouldn't think are using AI that are using AI. So,
Mm,
and that's where I think that's why it makes sense. It's not exactly where you think is where, and there's other areas that, like we talked about, like, hidden areas that you can look into is that there's a whole lot of electricity needed
yeah,
to
yeah.
to to
That's
to
the only
generate
thing.
to get these data centers. So what are you going to need for that? You need things like whatever the
Power
different
plants and
nuclear power
solar.
power plants, maybe nuclear or oil and gas, and
Yeah.
wind and solar, whatever it might be. You need to have some from production. Utility companies. Then you also so that's going to because you can't have data centers without electricity contracts for that. So those are some areas. And then there's other areas which you wouldn't think of. It's going into so many areas you wouldn't even know about right now. That's what the main thing. And that was what I thought was the interesting thing about this is that there's a lot of this expected productivity gains from AI that I think we don't even know where it's going. Like people every day are thinking of new uses of it then too. So, and it should make us much more efficient.
The price of electricity, though, seems to be going up tremendously, as at least it has been, right? And so there is this focus on shifting off peak. So in essence, using battery storage,
Hmm.
right? So you charge up the battery when energy costs less, and then you use the battery energy when energy costs more. So you're kind of shifting.
Right.
Are you seeing similar trends or whatnot in the market? Folks like shifting to like storage companies
Um,
and
yeah, and that's where I think that there is really a great, that's that's really where it comes down to. Is like, and it's not really fair to the average consumer sometimes that they're going to be paying a lot more for electricity. I think that's what I've seen is that, our utility bills are going to go up, and I think,
mm,
and I have a lot of people who work at like the next era energies of the world, and data centers might say they want a lot of electricity, but you have to give it to the consumers first. But that's where there's going to be a balance between that, and then you
mm,
also have, Bitcoin, which is a great user of electricity as well, like generating that too. So
mm,
there's a lot of need for electricity, and that seems like a given. There's also investments in things like the real estate of the data centers. Is it like a hidden area? Like we have an investment where they're getting a 50% markup by building these data centers. And it's like then they sell it after that to some other company. It's more like a bond, but it's like a really nice return you're getting if you have a data center connected with a contract for electricity. That's the main thing. They have to have both because a nice data
mm,
center without electricity is useless. So you have
mm,
to have that. And there's other areas that are hidden that people don't know about. You have to have something like a cooling system, like
mm,
in there then too, to look at that as well. And so there's a lot of like tertiary effects of this that people really don't see, and that's the part that really is kind of interesting. There's a lot of need for those things, and it's not necessarily in the areas that you would normally think of. And everybody knows NVIDIA produces chips. Like
mm,
it's really simple. NVIDIA does chips and the other chips that are going to go in there, but there's a lot of other, things you need to build a data center. And there's a lot of uses for artificial intelligence once it's all said and done.
mm.
So Paul, how you doing? I think you were on the seminar last time. He's probably muted now. Anybody else have any questions? I think I muted you there, Dan. I want me to unmute you.
No, I just unmuted myself. I'm good, Steve. Thank you.
Okay. So if nobody else has any questions, we will carry on, and um, people can ask me questions at their leisure then. So this is now recorded for posterity. So you can study the slides at your convenience, and look, if
Yeah.
anybody wants to find the slides, um, they'll be available probably in a few days on the website. So if anybody wants to look at heinwealth.com under the 2020 hindsight channel, that's where all the videos are going to be. So there'll be the ones that we've done already, which would be the immigration tariffs and the big beautiful bill. That was one seminar that'll be there shortly. Then we have the market update will be there as well. And then we also have the 5 risks of retirement seminar we did last night, and then this one, which is a subset. So that should be enough for now. And I think I've talked myself out for the last week or two. So I think
We'll
we're,
look for
I
your
think,
next invitation in the email.
yes, you look for a new one then too. What did you say, Dan? Small doses, right? That's gonna be my new nickname,
And,
right?
an acquired taste in small doses.
Acquired taste. I shouldn't have had my wife on the line for that one because she enjoyed that a little bit too much over there
Yes,
earlier.
I did.
I'm gonna hear that one. I think she might remember that one too. So that's
No,
really
she
good.
said she recorded
And
it.
it is recorded, so she could hear it then
Use
too.
it freely, no pride of
Yeah,
authorship
yeah,
here.
yeah. That's great. Thanks a
All
lot,
right.
Dan. Okay.
Good night, everyone.
Good
Thanks,
night,
Steve.
everybody.
All
Okay,
right.
bye.
Hey, good night. Hey, enjoy your trip,
Thank you.
Steve.
Okay, bye-bye.
Yeah, travel safe.
Okay, thanks. Okay, bye. Paul?